Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. And in today's video, we're going to tackle one of the biggest struggles that every entrepreneur will face. How do you get a business loan for a startup when you have no collateral and no business revenue yet? Now, if you've got a great idea and you maybe even registered your LLC or your corporation, but you're stuck trying to figure out how to actually get funding, then this video is for you. And by the end, you'll know exactly what lenders look for, how to calculate your qualifications before applying, and which programs are currently offering approvals for startups, even if you're starting from zero. So without further ado, let's get right into the video. So as many of us are painfully aware, the hardest part about launching a business is funding, especially in the early stages before you have any revenue coming in. You might need to buy equipment, cover marketing expenses, or need to purchase stock or inventory. But most traditional banks and lenders won't even give you a look unless your business is already generating some sort of cash flow. So if you're not at that level yet, what can you actually do? How do you prove yourself to a lender when your business hasn't made a dime? Well, when your business doesn't have income yet, lenders can't rely on your company's cash flow to judge whether or not you can repay a loan. So instead, they'll look at you. They'll look at your personal credit, your personal income, and your debt to income ratio. These three numbers will determine whether you can qualify for any type of startup loan. So let's break them down, starting with your debt to income ratio, because there's a lot of people with 800 credit scores that still get denied because of this one particular factor. Your debt to income ratio, or DTI, tells lenders how your income is already being used to pay debts. Here's how to calculate this. You want to add up your reoccurring monthly debts, things like your rent or mortgage, your car loan, if you have student loans, and at least the minimum credit card payments. Then you want to divide this number by your gross income, and that's going to be your income before taxes. So for example, if your total monthly debts add up to $2,400 and you earn $7,500 per month, your DTI is 32%. Most lenders want to see this ratio below 40% and ideally closer to 35% or lower, and that's because the lower your DTI is, the more confident they are you'll be able to handle a new loan payment. Keep in mind, this calculation is based entirely on your personal finances, not your business, since the startup doesn't have revenue yet. Your personal credit will be the next big factor. Even though this loan will be for your business, the lender still wants to know that you've managed credit responsibly in your personal life. You'll want to start by checking all three of your FICO scores, Experian, Equifax, and TransUnion, and you want to be aware that you can get your credit report from annualcreditreport.com completely free, but that does not include your FICO scores, and lenders almost always base their decisions on FICO and not your Vantage score. If you want to know more about this, I'll link a video explaining the difference as well as a way for you to get all three FICO scores completely free. The video is called Cancel Credit Karma or Don't Use Credit Karma, Do This Instead. Again, I'm going to link that right here. Knowing where your credit stands before applying will save you time and prevent unnecessary hard inquiries. If your business doesn't have income yet, the lender will need to verify your personal income. Here's what they might ask you for depending on your situation. Pay stubs or W-2s if you're a traditional employee, but you may also need to provide a 1099 form or invoices if you're self-employed. Tax returns if you're running your own business or freelance work. They may also ask you for pension or retirement statements if you're currently retired. Essentially, they need to confirm that you have a steady source of money that can cover the loan payments while your business grows. Once you've gathered both your credit reports, your proof of income, and you calculate your debt to income ratio, you'll be ready to explore real funding options. One of the most overlooked funding options for small businesses is the SBA Microloan program. Now, I've talked about this in other videos before where I discuss SBA loans in depth. I highly recommend you watch that video after this one if you want more information about the SBA and all the various loans that they offer. Now, this is one of those topics worth revisiting because it continues to help new entrepreneurs who don't yet qualify for financing from large institutions. The challenge is these loans aren't offered at most of your nationwide banks, and you can't just walk into Wells Fargo or Chase and ask for one. They operate through specialized community lenders, and most people have no idea where to start. Microloans are funded directly by the SBA and distributed through what's called intermediary lenders. These intermediaries are typically nonprofit, community development organizations, or often a CDFI, community development financial institutions. The SBA lends money to these organizations, and they in turn re-lend those funds to small business owners in their local area. These loans aren't guaranteed by the SBA. The intermediary lender is the one taking on the full risk. And because of that, the process is more personal, but it's also flexible and it's mission driven. The reason microloans exist is to serve entrepreneurs who fall through the cracks of traditional lending. Maybe you're a first-time business owner. Maybe your credit score is in the low 600 range, or you don't have enough collateral. A traditional bank will likely reject you under those conditions, but a microlender looks at the full story. They look at your business plan, your community involvement, your experience, and your potential. They're often more interested in how the money will impact your business and whether you're committed to making it succeed. Because the SBA provides the initial funding, these microlenders don't face the same strict capital rules that banks do. They can take on slightly higher risk borrowers, and the maximum SBA microloan amount is $50,000, but some lenders will extend up to $75,000 or even $100,000 through related community loan programs. Interest rates generally range from 8 to 13%, and repayment terms can go up to 6 years. It's not free money, but it's far more accessible than trying to get a $100,000 traditional SBA 7A loan when you're just starting out. Now, here's the biggest challenge: finding these lenders. Most people have never heard of them, and they're not usually advertised. You won't see them on TV commercials or billboards saying get a micro SBA loan here. To locate one, the easiest first step is to go to Google and search certified SBA microlender near me or SBA microlender in your city and or your state. For example, when I searched for microlenders in Las Vegas, Nevada, I found several certified options that specialize in helping local entrepreneurs, such as Nevada State Bank, which is designated as a preferred SBA lender, and it offers a variety of SBA loans. Bank of Nevada, they support small businesses with various SBA loan options. Clark County Credit Union, they distribute a variety of SBA business loans. Greater Nevada Credit Union, they help businesses apply for and receive SBA 7A and SBA 504 loans. There's G Bank, there's CDC Small Business Finance, so on and so forth. But these are examples of banks that you'll only find within my state. However, I'm sure if you were to do the same thing, you would get similar results in your state. Now, not every microlender is created equal. Each one has its own mission, eligibility requirements, and target industries. Some focus on women-owned businesses, while others on only minority-owned businesses or low-income entrepreneurs. To make the search easier, there are two main directories that I recommend checking. First, the SBA's official list of participating microlenders, which is available on SBA.Gov, and the second one is the Opportunity Finance Network (OFN) CDFI locator, which lets you search by state and loan type. When you use these tools, focus on organizations that are already headquartered in your state. Local lenders are often more responsive, and they're more likely to understand your business environment. It's also important to understand that SBA microlenders and CDFIs are not always the same thing, though there is some overlap. An SBA microlender is approved by the Small Business Administration to distribute microloans under specific federal programs, where a CDFI, on the other hand, is a financial institution certified by the U.S. Treasury Department that provides affordable financing to underserved communities. Many CDFIs also happen to be SBA microlenders, but not all. Some CDFIs offer their own small business loan programs that aren't technically SBA microloans, but they have similar terms. Sometimes they have smaller amounts, lower interest rates, and they're usually more community-based in support level. That means even if you can't find an SBA microlender in your immediate area, you can still reach out to nearby CDFIs. They often partner with the SBA or local government to provide alternative funding options. Currently, we are on SBA.Gov, and for your convenience, I put a link in the description that goes directly to the list of microlenders. You can click on that and you can follow along with me now. I'm going to go down to the state and territory section. I would suggest that you put in your state. For me, I'm going to select Nevada. And then when I do select Nevada, I'm going to click on filter so that it's the only one showing here. Now, after clicking on the filter, it brought me to Prestamo CDFI LLC, and it looks like this is a place that covers Nevada and Arizona. So I'm going to click on their website and see exactly how we can apply for funding. So when I clicked on the website, at the very top, I see there's an option to apply for funding. I'm going to click on that, and then it says, "Thank you for your interest. Please provide some basic information about your business." Now, in order for them to help you with the application process, you have to fill out your business information, which takes less than 1 minute. And it looks like they want to know what your business industry is. Now, of course, if you're in any of these industries, like any sort of business application, you're going to be denied. So I would suggest selecting the last one. My business industry is not listed above. And of course, you'll have a different type of form, but more than likely they'll ask the similar questions. Then it wants to know which state my company is licensed or operating in. Of course, for me, that's Nevada. And then after that, it wants me to add some contact information, and that is it. Like they said, it's less than 1 minute. So this is a simple example of when you would go to a CDFI and apply for business funding. Now, the next step is really anybody's guess. Again, every one of these places will be different depending on your city and your state. Currently, we are on OFN.org. That's Opportunity Finance Network. And just like before, the link will be in the description if you want to click on it and go straight to this page. So now I'm going to scroll down and take a look at the CDFI locator. Now, if you want to find the one that's in your state, you can actually go to the area served and then you'll scroll down. So for me, I'll do the same thing. Let's go to Nevada. And then we'll click on filter. All right, so it looks like I found one called Rural Nevada Development Corporation, and they're a nonprofit, and it looks like they were formed in January 1992 and has been responsive to the needs of rural communities by addressing critical issues such as affordable housing, down payment assistance, rehabilitation, and small business alternative lending practices, and has received certification from the Department of Treasury. So let's go to their website now. And then there is a loan application you can click on, as well as their financing policies, like the minimum size of any loan to the maximum, the fixed rate interest, loan terms, flexibility and collateral requirements. So you'd have to read through the details of course, whichever one that you're looking at, and then you would fill out the loan application. So again, I'm just looking at these randomly, just trying to figure out which ones are available. It'll be different for your city and your state. So now that we know how to potentially find these lenders, how do you know if an SBA microloan is right for you? Well, it's ideal for a business that needs smaller amounts of capital, typically under $100,000, and are either brand new or just a few years old. And if your credit score is below, let's say, a 650, and you don't want to pledge your home or your personal property as collateral, or if you've been denied by a bank for a traditional SBA loan, then the microloan route might be the perfect next step. It's also great for entrepreneurs in community-focused industries like local retail shops, service providers, or educational programs, because many lenders prioritize a business that creates jobs and strengthens their local economy. Just remember, the SBA requires that you demonstrate no credit elsewhere, meaning you must show that a bank turned you down before applying for a microloan. Now, in my experience with SBA loans, that is something that they state on the website, though they just will ask you this. No one really presents any information for you to prove it, but always keep that in mind. That might be something that comes up. That's just part of the SBA rule to ensure that these programs are used by those people who genuinely need them. Another thing that sets microloans apart from almost every other type of loan is the technical assistance. When you borrow through an SBA microlender or a CDFI, you don't just get funding, you get access to free or heavily discounted training tools. These programs often are funded by grants, which means the lender is paid by helping you succeed. They might offer workshops on bookkeeping, marketing, or financial management, or one-on-one business coaching sessions. That's a huge benefit, especially for new business owners who are still learning the ropes. With a traditional bank, once you get the money, you're on your own. But with a microlender, you also get an ongoing partner that wants to see you grow because your success helps their mission and their repayment terms. Even though microloans are more flexible, you still need to present yourself professionally, and that means having a clear business plan that outlines how you'll use your funding, updated financial statements or projections. Even if your business is brand new, you want to have proof that you understand the market, you have a plan, and you can generate income. Most microloans want to see that you've thought through your operations and can reasonably repay the loan. Remember, since they're lending money they're directly responsible for, they'll be thorough in reviewing your materials. Once you identify a microlender that fits your needs, here's what usually happens next. You'll fill out a short pre-application form online like we just demonstrated that'll ask about your business, maybe the loan, maybe even your purpose. Then you'll likely have a conversation with the loan officer who will discuss your goals and explain what documents that they'll need. And that's when all the things we discussed in the beginning will come into play. Typically, they require your personal tax returns, a business plan, ID verification, and some bank statements. This process is usually faster than traditional SBA 7A loans because you're working with a smaller organization that handles fewer applications. In many cases, you can get approved and funded within 2 to 6 weeks, depending on how quickly you submit your materials. While the funding amount may be smaller, the value of an SBA microloan goes far beyond just getting cash. It's an entry point into the world of business financing. And once you successfully repay one of these loans, you're building a track record that lenders can see. That makes it much easier for you to qualify for a larger SBA loan or bank financing down the road. Many business owners use their first microloan to establish credibility, purchase equipment, hiring their first employees, or covering startup costs, and then they graduate to higher lines of credit as their business grows. It's one of the smartest ways that you can build financial momentum without risking your personal assets. So to wrap this up, if you're a small business owner looking for your first startup loan, if you've been denied by a bank, don't assume you're out of options. The SBA Microloan program exists, and it's specifically for people like you. Again, these loans are flexible, community focused, and they're often paired with free educational resources that help you become a better business owner. And if this video helped you out, don't forget to like and subscribe so you don't miss future breakdowns on business credit, funding, and startup strategies. Thank you again for watching this video, and you guys have a wonderful day.